Yeah.
Yeah, just a question on the RU indicator, which has closed quite rapidly since the December meeting. How much weight do you put that as a measure of the outlook gap? If you look at chart 117, it's quite contradictory.
That's a good question. I won't be able to give you a precise answer, but I mean, I think the advantage with that measure is that it tends to be based on sort of more solid data that is not being revised later on, which is not the case for GDP data in particular. So therefore, I think that being more stable, that indicator is more useful. But I mean, it basically reflects a bit what Stefan showed before, that you can see this shortage occurring a bit earlier, given that you still, I mean, at least our analysis is that we still have some spare capacity, and that the levels, I mean, if you look at the level of, say, investment and exports, I mean, that's well below pre-crisis level still. So our final analysis is that there's some spare capacity, but there's some warning signals coming from that indicator. That's clear. But sort of our comprehensive analysis is not just only looking at that, but also on other measures that tend to say that there's some spare capacity left.
And I mean, the basic view we take here is that we look at many different types of gaps, because it has proven over the years hard to settle on a particular gap or a particular method of calculating a particular gap. Because then if you have your doubts about a particular gap, and then you sort of change over and over again from one to another, it's hard to sort of really figure out where you end up. And since there are many different ways of describing what's going on in the world, and you can look at it from many different angles, our approach is to look at the whole set, and then come to some kind of a conclusion when it comes to what is reasonable resource utilization in the economy.
Today's report, you recognized the fact that the actual mortgage interest rates paid by Swedish consumers actually has risen faster than the repo rate. Actually, it's about 1 percentage points higher than compared to the last rating hike cycle in 2006 and forward. The spread is now about 2.1%. How do you see this playing out? Are you actually satisfied with the spread, and are you seeing it increasing or decreasing going forward?
It's hard to sort of pin a number on that. We have many times in the past said that the spreads that we have observed before the crisis were just too narrow, that wouldn't be sustainable, and that we would come back to higher spreads. Now that has happened, and then what one needs to add to that is that if things continue to develop the way they have been developing over the past few years when it comes to Swedish households borrowing, we have also many times said that that's not sustainable. And in the long run, that increases the risk in the system as a whole. If market works, then that should imply higher spreads. And then on top of that, we are talking about various changes in the regulatory framework. So very, very hard to say that, and we don't have a number saying that this is sort of the spread, but expecting spreads to go back to what we saw a few years ago, that we don't expect to happen. And at the same time, to be clear, if one wants household borrowing to slow down a bit, then one would not adjust the repo rate path for that. Are there any more questions? If not, thank you for coming, and to those who have been... Oh, sure.
Yeah, Thomas from London, from Morgan Stanley. I want to ask two little questions, if it's possible.
Sure, please go ahead.
One is about the commodities prices again. I haven't heard that well, and the connection wasn't that perfect. I was wanting to ask about the risks of the second round effect from the commodities prices surge, or rather the magnitude of those risks, if that's possible, and your view on development in the core inflation as well. And the second question I have is about what's actually the level of the corona that you think can have triggered some sort of monetary policy actions, if I may ask. Thank you very much.
Okay, let me try. What we have assumed in the main scenario is that there will be some second round effects indeed from the higher commodity prices on inflation 2 years and 3 years ahead, but those are kind of small effects, but also what we have found typically on average in history has been the case when we have had commodity price increases of the kind that has now happened. And also typically, historically, these have been associated with higher interest rates, so the central bank has reacted to those, which is exactly one reason why they aren't bigger. And we can also see signs of things like this going on when we look at inflation expectations that tend to increase both 1 and 2 years ahead. Now the levels aren't very dramatic, they're still roughly around 2, but there's an upward trend in both of these expectations that could be linked to this commodity price issue, and we have to follow so that this doesn't spill over into longer term inflation expectations, in which case it would be a bigger problem. But we are in the belief that what we've done now suffices to sort of control the commodity price increases that we've seen so far. But then we have this risk scenario that looks into the issue if commodity prices would increase further, and that would then produce further monetary policy effects, as I was explaining before. On the exchange rate, one important message we believe is that there isn't a magic level for the exchange rate where policy would do a certain thing, but we try carefully to explain that there are different driving forces that could lead to a stronger exchange rate, but the policy reactions would be quite different depending on what is actually driving the strengthening of the kroner. There are several kind of different experiments that we present in the report that you can look at.
And one issue there is also, which might be worth adding, is that the issue is not only, as Per said, in terms of a TCW number, but it's also an issue which is about whether exchange rate changes are temporary or persistent. And that issue is not new at all. I happened to work here in the 90s, and we were stuck with the same issue back then. So it's, in that sense, nothing new under the sun. And one, sure, please go ahead.
No, I just wanted to thank you. Okay. Please carry on.
And then what has happened in the meantime is that back then we talked about these things in terms of a monetary condition index. Now we have a model machinery which is completely different in terms of how I actually do the modeling, but the kind of the outcome which Pat has showed with the various scenarios is basically, from a content point of view, pretty much the same. But we're in a better position today than 10 years ago or 15 years ago to illustrate these things, and that in itself is a nice step forward. Okay, thank you everybody for coming and listening in. Thank you so much, and then let's conclude for today.